Suppose in a company, cash sales, they are 20% of the total sales. Credit sales, 90,000 rupees. Gross profit, 25% on cost. Closing stock, 22,500 rupees. Opening stock, 7,500 rupees. Calculate stock turnover ratio. Stock turnover ratio is equal to cost of goods sold upon average stock. Opening stock and closing stock both are given, so it's very simple to calculate average stock. Average stock is equal to opening stock plus closing stock upon 2, means 22,500 plus 7,500 upon 2. It means 30,000 upon 2 is equal to 15,000 rupees. Means average stock in this company is 15,000 rupees. Now we are looking for cost of goods sold. In the given information, cost of goods sold is not given, but there are so many other information they can help me to reach cost of goods sold. So cost of goods sold is equal to sales minus gross profit, because we can calculate sales as well as gross profit on the basis of the given information. It's clearly given in the question, cash sales are equal to 20% of total sales. It means if total sales is equal to 100, then cash sales is 20. It means credit sales is 80, because total sales is made up of cash sales and credit sales. It means if the total sales 100, cash sales 20, credit sales 80. On the basis of this thing, we can calculate the equation. If the credit sales is 80, then total sales 100. If credit sales is 90,000 rupees, then total sales 100 upon 80 into 90,000. It means it will be equal to 1,12,500 rupees. So one thing is clear, that our total sales are 1,12,500, but we are looking for cost of goods sold. Sales we have got. Now we have to look for gross profit. It's clearly given gross profit is equal to 25% on cost. Sales is made up of cost of goods sold and gross profit. Suppose our gross profit is 25 and cost is 100, because gross profit is 25% of cost. It means if the cost is 100, gross profit is 25. So total sales will be 125. It means if the sales is 125, then the cost is 100. But our sales are 1,12,500. So if the total sales is 1,12,500, then cost will be 100 upon 125 into 112,500. That will be equal to 90,000 rupees. It means cost of goods sold is 90,000 and stock, average stock is 15,000. So stock turnover ratio will be equal to 90,000 upon 15,000. That is equal to 6 times. If we want to calculate the turning of the stock in months, can be calculated. That will be 12 months upon 6, means 2 months. If the stock is turned in this company after every 2 months. Now we'll talk about debtors turnover ratio. It can be called receivables turnover ratio. So far this debtors are concerned. Debtors means the customers to whom we have sold the goods on credit basis. Naturally, this relationship will tell you how the debtors are being utilized in the company. That is called debtors management. How efficient is the debtors management? One thing should be clear. If there is no credit sales in the company, there cannot be any debtors. Debtors management means how the money is being recovered from the debtors. Suppose you sell the goods and you recover the money from the debtors after 2 months. And next year you find that you are getting the money from your debtors after every 3 months. What it means? Your funds are blocked with the debtors. Your recovery is not so good. So it tells about the debtors management, or you can say how efficiently debtors are being managed in the company. And the formula is credit sales upon average debtors. Naturally, it establishes a relationship between debtors and credit sales. Be careful. Debtors means debtors and BR as well. I mean to say bills receivable. Although in the formula we write only credit sales upon average debtors, but debtors means average debtors and BR. And average debtors, how will you calculate? Simple thing. Opening debtors plus closing debtors upon 2. I mean to say opening debtors and BR plus closing debtors and BR upon 2. But one thing you should be very, very careful. When I am talking about debtors, you should not take net debtors. Here debtors means gross debtors. I mean to say before provision for doubtful debts. Sometimes you may face the problem in the question. Suppose opening debtors are not given and only closing debtors are given, but you have to calculate average debtors, but you don't have opening debtors. In that situation, closing debtors will be assumed average debtors, but you will have to write down the note at the footnotes that closing debtors are being assumed as average debtors. Or in some question you may find opening debtors but closing debtors are missing. In that situation, opening debtors will be taken as average debtors. Be careful. Debtors means debtors and BR, and gross debtors, not net. And sometimes in the question it's given that the sales of the company was this much, but it's not clearly stated that these sales are credit sales or cash sales. So how will you find the credit sales? In that situation, you will have to assume that these sales are the credit sales. Means in this company, all sales are credit sales. But this thing must be written in the footnotes. Suppose in a company, credit sales are 1 lakh and average debtors are 20,000 rupees. So what will be the debtors turnover ratio? It's a very simple formula. Credit sales upon average debtors. That will be 1 lakh upon 20,000 is equal to 5 times. Means debtors turnover ratio in this company is 5 times. It means in a year the debtors are turned 5 times. If you calculate in the days, that will be 365 days upon 5. Means 73 days. What it means? You recover the money from the debtors on average basis after 73 days. And it is also called average collection period. Average collection period means 365 days upon debtors turnover ratio. If you are asked to calculate average collection period in months, then it's very simple, 12 months upon debtors turnover ratio. If you are asked to calculate average collection period, means ACP, in weeks, then it will be 52 weeks upon debtors turnover ratio. Higher is better. I mean to say, if your debtors turnover ratio is going higher, this is good for company. For example, last year debtors turnover ratio was 2 times. Now it is 4 times. And next year it is 6 times. What it means? In the first year, average collection period was 6 months. And in the next year, the average collection period was 3 months, and in the next year, the average collection period was 2 months. It means your recovery from the debtors is getting better and better. It means your debtors management is getting better.